Securing funding is a critical step for businesses looking to grow and scale their operations. Two popular avenues for raising capital are private equity and venture capital. Both involve investments in businesses, but they differ significantly in terms of their approach, target companies, and stages of business development they focus on. This video will explore how to secure funding through private equity and venture capital, outline effective investment strategies, and discuss the pivotal role of private equity in driving business growth. Understanding private equity and venture capital. Private equity. Private equity refers to investment funds that buy and restructure companies that are not publicly traded. Private equity firms typically target mature businesses that require revitalization or expansion. They invest substantial amounts of capital and often take a controlling interest in the companies they invest in. The goal is to improve the company's financial performance and sell it for a profit after a few years. Private equity investments often involve a combination of equity and debt financing to maximize returns. Venture capital. Venture capital is a form of private equity focused on early-stage, high-potential startups. Venture capital firms invest in companies with innovative ideas and significant growth potential, but that are in the early stages of development and may not yet be profitable. In exchange for their investment, venture capital firms usually take an equity stake in the company. The primary objective is to support rapid growth and achieve a high return on investment through an eventual exit, such as an initial public offering or acquisition. Venture capital investments are typically higher risk, but also offer the potential for higher returns. How to secure funding. Prepare a solid business plan. Whether you're seeking funding from private equity or venture capital firms, a comprehensive and compelling business plan is essential. Your business plan should outline your business model, market opportunity, competitive landscape, revenue projections, and growth strategy. Additionally, it should highlight the unique value proposition of your product or service and provide a clear roadmap for achieving your goals. Including detailed financial forecasts and a well-defined go-to-market strategy can further strengthen your case. A robust business plan demonstrates to potential investors that you have a deep understanding of your market and a clear strategy for growth. It should also address potential risks and how you plan to mitigate them. Investors want to see that you have thought through every aspect of your business and are prepared to execute your plan effectively. Network and build relationships. Securing funding often hinges on who you know. Attend industry events, join professional networks, and seek introductions to investors through mutual contacts. Building relationships with investors before you need funding can increase your chances of success. Engaging with potential investors early on allows you to understand their investment preferences and tailor your pitch accordingly. Networking is not just about making connections, it's about building genuine relationships based on trust and mutual interest. Follow up with contacts, keep them updated on your progress, and seek their advice. Over time, these relationships can open doors to valuable opportunities and partnerships. Understand investor requirements. Different investors have different criteria for investment. PE firms look for established companies with stable cash flows, while VC firms seek innovative startups with high growth potential. Research potential investors to understand their investment focus, stage preference, and portfolio companies. This knowledge will help you identify the most suitable investors for your business and tailor your pitch to meet their specific criteria. Understanding investor requirements also involves knowing their preferred deal structures and investment horizons. Some investors may prefer minority stakes, while others seek control positions. Knowing these preferences can help you align your expectations and negotiate terms that are acceptable to both parties. Craft a persuasive pitch. Your pitch to investors should be concise, engaging, and data-driven. Highlight the problem your business solves, your market opportunity, and your unique competitive advantage. Be prepared to answer questions about your financials, growth strategy, and exit plans. A compelling pitch deck should include key metrics, customer testimonials, and a clear vision for the future. Practice your pitch to ensure you can deliver it confidently and effectively. Demonstrate traction and potential. Investors want to see evidence of traction and growth potential. This can include customer acquisition metrics, revenue growth, partnerships, or technological advancements. Demonstrating that your business is gaining momentum can make it more attractive to investors. Showcasing successful case studies, user feedback, and milestones achieved can further validate your business's potential. Investment strategies. Equity financing. Equity financing involves selling shares of your company in exchange for capital. This is the most common form of financing for both private equity and venture capital investments. It provides investors with ownership stakes and aligns their interests with the long-term success of the business. Equity financing can dilute ownership, but it brings in capital without the obligation to repay. Equity financing is particularly attractive for companies with high growth potential but limited cash flow. It allows businesses to raise significant amounts of capital to fund expansion, research and development, and other strategic initiatives. Investors benefit from the potential upside if the company performs well. Debt financing. In some cases, private equity firms may use debt financing to acquire companies. This involves borrowing money to finance the acquisition, with the expectation that the company's future cash flows will cover the debt repayments. Debt financing can amplify returns, but also increases financial risk. It is often used in leveraged buyouts, where the acquired company's assets serve as collateral for the loans. Debt financing can be an effective way to enhance returns on equity by using leverage. However, it requires careful management to ensure that the company can meet its debt obligations. Private equity firms typically implement strict financial controls and cost-cutting measures to optimize cash flow and ensure the company can service its debt. Hybrid financing. Hybrid financing combines elements of both equity and debt financing. For example, convertible debt starts as a loan but can convert into equity at a later date, often during a subsequent funding round or initial public offering. This provides flexibility for both investors and businesses. Hybrid financing can be an attractive option for startups seeking to minimize dilution while still raising capital. Strategic partnerships. Forming strategic partnerships with other companies can provide access to additional resources, expertise, and markets. These partnerships can take various forms, such as joint ventures, strategic alliances, or co-development agreements. Strategic partnerships can enhance your company's capabilities, drive innovation, and open up new revenue streams. Strategic partnerships can be particularly valuable for entering new markets or developing new technologies. They allow companies to leverage the strengths and resources of their partners, reducing the risks and costs associated with new initiatives. The role of private equity in business growth. Operational improvements. Private equity firms often bring operational expertise to the table. They work closely with management teams to identify areas for improvement, streamline operations, and implement best practices. This hands-on approach can lead to significant performance enhancements and value creation. Private equity firms may focus on improving efficiency, reducing costs, and optimizing supply chains. Operational improvements can have a profound impact on a company's bottom line. Private equity firms often implement performance metrics and incentive structures to align management's interests with those of the investors. By driving operational excellence, private equity firms can enhance profitability and create value for shareholders. Financial restructuring. Private equity firms may restructure a company's finances to optimize its capital structure. This could involve reducing debt, renegotiating terms with creditors, or reinvesting profits into growth initiatives. Financial restructuring can strengthen a company's balance sheet and improve its financial stability. Private equity firms often implement robust financial controls and performance metrics to drive accountability. Financial restructuring can provide the company with the financial flexibility needed to pursue growth opportunities. By optimizing the capital structure, private equity firms can reduce the cost of capital and enhance the company's ability to invest in strategic initiatives. Strategic direction. Private equity investors provide strategic guidance and long-term vision. They help companies identify growth opportunities, enter new markets, and make strategic acquisitions. This strategic oversight can accelerate business growth and expansion. PE firms leverage their industry expertise and networks to drive strategic initiatives and unlock value. Strategic direction involves more than just identifying growth opportunities. It also includes setting long-term goals and developing a roadmap to achieve them. Private equity firms work closely with management teams to ensure that strategic initiatives are aligned with the company's overall vision and objectives. That's all for today's video. If you found this video helpful, make sure to give it a thumbs up and subscribe to our channel. Don't forget to hit the notification bell so you never miss an update. Thanks for watching, and we'll see you in the next video.